Decision time month-end flow combined with midterm elections uncertainty was more than enough to keep investors busy, and there were enough head fakes from the Trump camp regarding progress on a trade deal with China to keep political uncertainty boiling. While the equity market and risk sentiment stabilize around current levels and some of the worst-case scenarios around trade war hedges unwind, overall risk sentiment has failed to pick up. Investors are far too wary of an empty promise, but ultimately, they will need to decide how much of President Trump's olive branch to China was a ploy to boost equity markets ahead of the U.S. midterm elections on Tuesday and how much of it is a bona fide attempt to reach an agreement. Speaking of unwinding of worst-case scenario bets, USD/CNH posted a bearish outside week after fast money ran for the exit as a push above 7 would be less likely ahead of November G20. If U.S.-China negotiation channels remain open, an escalation on the U.S. tariff front remains less likely, so China will be more incentivized to keep yuan weakness in check. Nonetheless, the rally in the RMB complex also helped other Asian currencies which had their best week since late January. Oil markets. Regardless of whether the markets are getting it right or not on the waivers debate, the temporary waivers on U.S. sanctions against Iranian crude oil exports for 8 nations provide at least some short-term cushion against the impact of sanctions due to take effect today. While Iranian productions and exports declines will likely accelerate in the months ahead as massive importers like China and India become 100% compliant on the sanction front. Traders are still dealing with increased flowage from the U.S., Russia and even OPEC. Markets are looking for a base, perhaps signaling a period of consolidation, but in the absence of a supply shocker, price retracements may be elusive and short-lived as the market deal with what appears to be a near-term oil surplus while factoring in a slowing global economy. Gold markets. Wedding season and demand ahead of Diwali are keeping jewelers busy. However, this belies the fact that gold demand for the first 9 months of 2018 was the weakest since 2009, this despite central bank adding to gold reserves throughout August and September. But keep in mind much of Asian demand was sidelined due to the higher cost of gold in real currency terms as Asian currencies like the rupee and yuan have weakened considerably this year. But Friday's U.S. payroll data, where average hourly wages increased above 3% for the first time since 2009, triggering a $5 drop on gold prices as this more robust inflation print keep the Federal Reserve Board's interest rates rise trajectory in check. Still, with enough political uncertainty brewing, gold should remain bid on dips as if the GOP loses significant support causing the USD to wobble, gold should be a hot commodity to own. Asian markets. Local investor sentiment will remain nervous after local stock markets rallied hard on Friday, only to see fund managers selling U.S. stocks on the numerous Trump headline twists and turns. The Malaysian ringgit. Although the government forecast a deficit of 3.7% for its 2018 budget, up from earlier forecasts of 2.8%. The ringgit gained on Friday due to a weaker yuan, but investors were also cheering when the government announced it was doubling its dividend from Petronas. Main focus today. PMI numbers will be released for Singapore, Hong Kong and the Philippines. The market's attention will be on the cakes in China PMI numbers, where a negative number will raise more hopes for stimulus. Malaysia will report trade figures while Indonesian GDP will also be published. Chinese President Xi will be addressing the first International Import Forum in Shanghai. Earnings in the region are expected from SoftBank, Westpac, DBS and State Bank of India.